In this Advisor You Can Talk To podcast, we discuss risks and opportunities we see when it comes to investing in and through 2021. Hello, this is Jim Lowell, and I'm the Chief Investment Officer at Advisor Investments. I'm here with another Advisor You Can Talk To podcast, and today I'm joined by several members of our outstanding investment research team and its team leader, as well as one of our expert dividend income portfolio managers, to drill down into their areas of expertise and discuss specific risks and opportunities they see as we head into 2021. Speaking of heading into 2021, Dan Wiener, Chairman of Advisor Investments, and I offered our bird's eye view of investing in and through 2021 in a recent podcast. But here, I'm going to orchestrate many moving research analysts and parts, the spokes to our overall 2021 investment outlooks wheel. Jeff, to begin with, you lead our analysts in the research team. Can you share how the team's research is both divvied up among our analysts and how we unite their spokes to our overall investment approach?
I'd be happy to. Thanks for having me on this new format podcast, Jim. So as the investment team, there's 10 professionals who are dedicated to investment research at the firm. And as you alluded to, we're kind of divided up into a few sub-teams or maybe areas of expertise is a better way to think of it. You mentioned Charlie, who we'll hear from. He leads our dividend income team. Jen Zebniak, who we'll hear from, works really close with Chris Keith on our managed bond program. Josh Jabala leads our tactical efforts. And then we have our core strategies, our strategic long-term diversified portfolios, which you and I and Dan and really the whole team work on to bring our best ideas from all those different spokes. We do have a senior investment committee, which provides some oversight for those teams. But the idea is to let each team really manage their strategy to the best of their abilities day to day without too much hassle or red tape to try and cut through to make their best investment decisions. When it comes to the analysts on those core portfolios, and I count myself among those ranks alongside Liz Leprod and Jen Zebniak, who you'll also hear from in a moment. But we're generalists. We try and cover the broad investment universe. And we made this shift from just being specialized in, say, large cap US stocks to being generalists because it leads to better conversations. It means that we've got more than one set of eyes on an investment idea. And then to round it out, how do we bring all those different points of view together, whether it's from an analyst or from Charlie and his team or from Chris on the bond world? Well, we meet every Monday at our weekly research meeting. We get all 10 professionals together and we discuss markets, portfolios, opportunities, risks, trends, really digging in on individual investment ideas as well as trying to keep the big picture in mind. And then, of course, there's plenty of emails going back and forth. I would say water cooler talk, but maybe it's now Zoom talk happens as well, kind of those ad hoc conversations. Sometimes the best ideas come from just those spur of the moment conversations.
Thanks, Jeff. I want to move quickly to Liz, equity research analyst. Liz, one of your more brilliant pieces of research persuaded all of us that investing in international mid, small cap stocks not only didn't import more risk into the portfolio than investing in traditional international large caps, but it often delivered better total returns in terms of your research. And this sounds kind of counterintuitive. So can you explain it to us? And can you start perhaps with explaining why investing overseas makes sense at all?
Sure. So Jeff and I actually dug into this pretty well on a separate podcast a few weeks ago. So I'm going to keep it high level here, but for my full-winded response, definitely give that a listen. But yes, let me start with why international first. We do get that question a lot, and I would say rightfully so. The US stock market has outperformed most international markets for the last 10 years or so. But I'll go ahead and highlight two reasons to invest globally. The first is diversification. If the US stock market starts to decline, you really just don't want all your eggs in one basket. It's as simple as that. Secondly, I think if you're looking today, there are some tailwinds for international. You have cheaper valuations, certain economies recovering at different times, and a weakening dollar, which benefits international companies. And we saw that happening last year. And I think there are reasons that we're going to see that continue this year as well. when it comes to kind of that counterintuitive risk relationship. So I think we're a little biased being in the US because here small cap stocks tend to be riskier investments than large cap stocks. Abroad, however, small and large cap companies pose essentially the same levels of investment risk. I think the difference in risk relations really just comes down to the type of companies. So in the US, the largest allocation in the Russell 2000 are biotech companies. Typically, these companies are not profitable for a long time, and their stock prices rely on binary outcomes, which can lead to big stock price swings. And we saw, a ton of that last year with the vaccine race. Internationally, however, small caps are more concentrated in sectors like real estate, banks, and broader industrial companies, which are more likely to be profitable and potentially more stable when they go public.
I mean, that's a very interesting distinction, that boots on the ground, selling your goods and services to your neighbors as opposed to trying to bankroll great ideas and see if they pan out.
Right.
It's clearly helped us add some value to the portfolio on both relative return, but also risk-adjusted perspectives. So thank you for that perspective, Liz. And while I have you, why don't we dig into yet another one of your research gems, which was all about Bitcoin. And I know we don't have hours to discuss this, but in more than a few nanoseconds, can you describe to us what Bitcoin is, what the current state of play, maybe current state of mania on Bitcoin is, and whether or not it even qualifies as an investment, or is it purely a speculative gambit?
That's a great question. It's definitely been something that's been in the news a lot lately. I sometimes do think you need hours to explain it, but I will try and kind of get to your questions briefly. So to start with, what is Bitcoin? At its simplest definition, it is a digital called cryptocurrency. This means that there are no physical coins. If you own a Bitcoin, you basically just own the right to transact with that Bitcoin through a crypto exchange. And really, the idea behind Bitcoin is that it is an entirely digital and decentralized currency. So, unlike the US dollar, which is backed by the government, there is no single entity behind Bitcoin. Transactions, at the simplest of explanations, are verified by other computers, known as miners. So, that's just upfront, what is Bitcoin? We've seen the price of Bitcoin run up like crazy recently, but it's been around since its invention by an anonymous coder since 2009. It gained traction in 2017 when the value of a Bitcoin went from 1,000 US dollars, peaking at $19,000 at the end of that year. Unfortunately for Bitcoin investors or owners, it crashed some 80% the following year. Fast forward to 2020, we have a global pandemic, a recession, low interest rates, increased money supply, and thus potential inflation spike expectations. With all of those factors, I think investors realize that maybe putting money into the crypto space could be a better way to earn some cash than maybe low interest bearing instruments or gold. I think it then snowballed as large financial institutions and investment managers began to endorse and offer it. And then maybe some fear of missing out set in as the price rose and then more and more people piled in. So that kind of brings me to the question of, is it an investment or is it just speculative? I think it's both. I think it's a speculative investment. You can buy it and trade it for varying values in a market, but given its volatility, it's a risky one for sure. I mean, don't forget, when the market corrected last March, the S&P 500 was down 34%, gold down 3.5%, and Bitcoin, without the big run-up we've seen lately, was down 54%. So
Ouch.
I wouldn't, yeah, exactly. So I would not think of it as a preservation of value or a gold substitute. I will say though, unlike 2017's boom and bust, I do think crypto has gained some actual institutional traction over the past year, which could potentially bring in a higher support line on the value if it were to bust again. Would I personally allocate a large portion of my portfolio here? Probably not, especially not after it has run up more than 300% over the last year, with 200 of that just within the last 3 months. But, I can understand the investment thesis. And if you want some exposure, I think as long as you have the right risk appetite and tolerance for it, then sure, buy some. My advice to you then is maybe don't buy more than you'd be willing to lose right now.
Excellent advice, Liz. And it's not to say that we are not thinking as hard and as fast as we can about cryptocurrency and the inevitable evolution towards some sort of stable store of value. But you're absolutely right. Bitcoin is not there yet, not in any way, shape, or form. So Liz,
Right.
you just touched on one area to consider in 2021, international small caps, mid caps. One sort of speculative potential investment gambit to learn more about, but maybe certainly not bet the ranch upon. Let's bring some belt and suspenders investing back into the room. And in order to do that, let me bring in Jennifer Zebniak, income research analyst. Jen, bond investors typically hate surprises. So naturally, I'm going to ask you, what surprised you the most about 2020's bond market?
Yeah, so from an asset class that you'd expect to be pretty stable, I would say what surprised me the most was the speed of the recovery after the sell-off that we had seen in the spring. Bonds ended up having a really good year overall. After spreads widened pretty dramatically in March, we saw those yields on almost everything come back down and reach near or all-time lows, which really just showed how the Fed stepping in quickly had really helped.
So looking at your 2021 crystal ball, we know that last year we saw continued, really increased interest in taxable muni bonds. What are they? Are they riskier than non-taxable muni bonds? And what kinds of risks do you associate with both non-taxable and taxable muni bonds? And is there enough of a yield reward for investors to consider them?
Sure. So typically, when an investor thinks of a muni bond, they do think about those tax exempt securities. But taxable muni bonds are exactly what they say they are. They're taxable. So I would say they're no riskier than your regular tax exempt muni bond, but it's still important to do your due diligence on each particular issue or issuer. Taxable munis do offer slightly more yields than a tax exempt muni because you do need to pay taxes on those. But there are times like last year, for example, where an investor is able to get more yield in a taxable muni versus a corporate bond, which is also taxable. And like you said, taxable munis have been seeing a lot of demand. They saw a record issuance last year, and they've had their best year of performance since 2011.
So I'm going to put you on the spot and ask you, maybe it's almost a quasi-political question. We, as an investment research team, we think we'll continue to see some forms, manners, modes of stimulus coming from the Fed, fiscal stimulus, certainly looking to global counterparts to do the same to really try and safeguard the domestic global economy against the toll of the current pandemic we're managing through. If we see a massive infrastructure stimulus spend in 2021, does that bode well for muni bonds?
I think so. Investors, even with yields so low, I would argue that muni bonds are even more of a reward, right? Because for someone who's looking for a tax exempt form of income, I mean, with muni bonds, you keep all of your income. So with yields already so low, I think there is still a strong demand for munis, and the infrastructure bill and then the supply that will come with that will be well received.
Especially perhaps if we see some changes to tax laws that might make muni bonds even more attractive. We'll have to wait and see on that one. One of the things we can't wait and see on is yield, and the question of what's an income investor to do in 2021 and what remains a very low yield environment. What are your thoughts on that?
My thoughts are, please don't give up on bonds. They are still always there when you need them. Yes, yields are low, but they are not negative here in the United States. And an investor is still earning some yield, even though it is a low yield. They'll still be there and play that defensive role in your portfolio.
Excellent, Jen. Thank you very much. I'm now going to transition to Charlie Toole, Dividend Income Portfolio Manager. And of course, Charlie, we just heard from Jennifer, one of our bond experts, that the yield is hard to find, income hard to find. Your expertise may enable stock investors and bond investors to have their cake and eat it too. Can you briefly define why dividend stock investing can and likely should play a role in virtually every investor's portfolio?
Thanks, Jim. Yeah, I think that dividend stocks do play a role in just about every portfolio. When you're investing in a dividend-paying stock, you get the benefits of the income, but you also get the benefit of capital appreciation that comes with owning stocks. And so you can, depending on your risk tolerance, combine dividend-paying stocks with municipal bonds and have a nice, well-rounded portfolio that's delivering you income. What we do here is we focus on a specific part of the dividend market, and those are companies that are called dividend growth stocks. Those are companies that raise their dividends year in and year out. And to be able to do that consistently year over year, these types of companies are typically financially strong with battleship balance sheets, lots of cash on the balance sheet, and a strong and solid business model that generates a lot of cash that they can return to shareholders. One of the things that's happened over the last year is this segment of the market underperformed. But we think a lot of the companies that we own and that are in the space have set themselves up well for 2021. These are, like I said, strong businesses. They've increased market share, or have strong balance sheets where they can go out and maybe acquire companies that can help strengthen their businesses going forward.
So, Charlie, many investors still think that dividend stock is a synonym for value stocks. Can you discuss how this has changed and how it's reflected in your portfolio, and maybe touch on valuations on both the growth and value side of the dividend stock ledger?
Sure. I think it's very easy for investors, old people like me, that remember what dividend stocks used to be. And those used to be telephone companies or other utility companies, big oil companies and big banks. And that is what dividend stocks used to be. But now there are stocks in every sector that are paying a dividend, including growth sectors like technology and biotechnology. So you can find, or you can build a portfolio of dividend paying stocks that covers all the broad sectors. I think that, looking at valuations, there's certainly a discrepancy between higher growth stocks or companies and traditional value companies. And while I won't get into the growth versus value argument, I will give an example just based on different sectors. A traditional value sector would be the energy sector. And if you're an energy company, you have to spend a lot of money to discover oil. And then once you discover where the oil is, you have to spend a lot of money to put in the infrastructure to get it out of the ground. And you have to keep doing that to replenish those reserves. So that's a lot of cash that an energy company has to spend. On the flip side, if you're a technology company, say a software company, you need to hire people to build the software, and you need to hire or buy computer and servers to run that software. But that's a small amount of cash that you have to deploy relative to the energy company. So when you look at a lot of growth stocks are what we would call asset light. They don't have to spend a lot of money to build a big infrastructure around how they run their business. And so that would lead to a higher valuation, meaning because when the tech companies or when the software company is generating revenue, a lot more of that revenue is kept for the investors, whether it's dividends, stock buybacks, or reinvesting in the business. For a lot of value stocks, they have to put a lot of their revenue into maintaining their business, so they don't generate as much cash. And so that's where you get the discrepancy in valuation. But over time and over the last few years, we've seen a lot of money gravitate towards that growth sectors, those growth stocks, and that's driving the valuations higher relative to the value sector or sectors.
Excellent. Jeff, team, we believe in disciplined diversification, and thanks to Liz, Jen, and Charlie for providing diversified views on the stock and the bond market. Let me bring it back to Jeff to weave together all we have just heard. And Jeff, ask you to deliver, as you do every week for the investment committee and our whole firm, a summary view. What you think are the biggest investment and income challenges and opportunities in 2021.
Oh, that's a tall order, Jim. I'll see what I can do. But my first thought is actually, while it feels like we're living through a year for the history books, the challenges we face as investors are really the same that we always do. I mean, we know that over time, investing in the stock market has been the best way to grow and compound wealth. But the price of doing so, of growing your wealth, is that the stock market's volatile. There's declines, there's bear markets, there's curveballs and risks out of left field, as we've got a great example of this past year. And on average, stocks drop 14% from a high point on average every year. So we know that we're going to face difficulties and challenges, and there's going to be periods where it feels like, the market's going to keep on going down, and that the end of the world is near. But we've also seen examples that the economy and the markets are enduring and adaptable. So if I think specifically to 2021, I think the biggest challenges and opportunities are really two sides of the same coin. And that's the return to normal, if we can call it that, or if we ever do end up going back to normal. But nonetheless, there is a lot of pent-up demand and activity out there. We all want to get back to being social and being mobile and traveling and going out to eat as we used to do. And there is a lot of opportunity in that. At the same time, I think that's also where the biggest challenge is that if the economy is growing, what does that mean for interest rates and bond prices? I agree with Jen when she says, don't give up on bonds. They have a valuable role to play in your portfolio. But yields are low, and that suggests that the returns coming from that side of our portfolio are also going to be low in the years ahead. And so that's a challenge that we have to think through and plan for as we move on down the road. And if I could end on just one kind of big picture idea, I'm always and ever the long-term optimist. And I don't necessarily know what will come out of this past year, but I do know that when we're faced with challenges, problems to solve, that's when the seeds of progress are planted. When everything's going well and smoothly, there's less need to innovate or find new ideas. But again, when we have a problem to solve, well, that's when we make new discoveries and advances. I just saw today that 1.5 million new businesses were started in the US in the third quarter alone. In pre-COVID times, the high was 800 to 900,000 new businesses in a quarter. So a lot of new businesses were started. That's a huge increase. And of course, many of them are going to fail, but the seeds of growth and progress have been planted there.
Excellent point to end on, Jeff. Where danger exists, there the saving ground arises. And in what remain uncertain times, one thing is certain. We haven't changed our investment discipline based on what others fear. Instead, for more than 25 years, we've invested based on the facts we know. And no matter how volatile the next 25 days or 25 years will be, we look forward to helping you secure your financial future. And look to our podcast as one way in which we're always not just on your side, but by your side every step of the investment way. And on that note, this has been Jim Lowell and key members of our Advisor Investments research and manager teams. Many thanks to each of today's participants and to all who listened in to another Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcast. And of course, your feedback is always welcome. And if you have any questions or topics you'd like us to explore, email us at info@advisorinvestments.com. And thank you for listening.